Good afternoon, and thank you for participating in today's live webinar, exclusively available for BMO Investor Line clients. My name is Serge Pepin. I'm Vice President, Investment Strategy, BMO Global Asset Management. Today, I'll be discussing key topics that are affecting our current financial markets. Definitely, the great rotation has been quite a debate. Even some people or some pundits have looked at it as being the great lie of 2013. We don't believe it is a great lie. We think there is a rotation going from fixed income to equities. It may not be that great at this point, but definitely we're seeing evidence and statistics showing us that more and more investors are leaving the fixed income market where they found solace over the past 3-4 years, and now going into the equity market. So this is what we've seen in the first and the second quarter of this year. In terms of our forecast attempt, and this is as of July 5th, from our folks at BMO Capital Markets, we're seeing still economic growth both in Canada as well as the U.S. Currently in Canada, we're calling for a 1.6% growth rate in 2013. In the U.S., around 2%, and that's come down over the past few months, starting around 2.3% now to around 2%. In terms of the housing market, definitely some stability in the U.S., where we're seeing now more and more activity in many pockets, and pockets that were quite weak in the U.S. Now these metropolitan areas are gearing up, if anything, and have been gearing up for the past number of years. So we're seeing prices being much healthier. We're seeing bidding wars as well in many cities such as Phoenix and Las Vegas as an example. In Canada, however, the housing market is cooling off. However, it is not cooling off to an alarming pace. Sort of the pundits sort of calling for a crash in the housing market. We don't believe so. If anything, it's sort of more of a leveling off at this point. We are definitely seeing some pockets of some metropolitan areas in Canada sort of suffering more than others, Vancouver being a case in point, but even then, activity has leveled off there. In Toronto, it's mostly on the condo market that we're seeing some weakness. The single home market is still relatively healthy, and prices across Canada for most metropolitan areas are still up at this point if you look at year-over-year numbers. In terms of unemployment, both Canada as well as the U.S. should remain relatively stagnant in, actually that should read 2013. About 7% in Canada, about 7.5% in the U.S. on average. Now, you recall that the Federal Reserve in the U.S. said that it wouldn't be ready to slash, if you will, its quantitative easing until, or even raise interest rates until the U.S. has an unemployment rate of about 6.5%. We believe that around 6.97% that the Federal Reserve will start sort of tapering, if you will, its quantitative easing and talking more and more about raising interest rates or normalizing interest rates. In terms of the Bank of Canada, main discount rate as well as target rate at this point, there's really no need for it to rise at this point. Even the new governor, Stephen Pawles, has said that there is still quite a bit of lax in the Canadian economy. The Canadian dollar right now sort of trading below the U.S. dollar. We had known quite a bit of good above parity trading over the past year and a bit, and now over the past couple of months we've seen the Canadian dollar sort of trail behind the U.S. dollar. We think that it's temporary at this point, more so than anything else. Today, just because of good numbers out of retail sales, we did see a little bit of a bump up in the Canadian dollar. That's based on the Bank of Canada noon rate. In terms of commodity prices, a lot of this will depend largely on China and its own economic activity. and revival, if you will. We believe that China is experiencing some sort of lull. However, we think that the Chinese government will come in, will eventually step in to make sure that the Chinese economy does not, or its growth rate does not go below 6.5%. We still see this at around 7% in 2013. In terms of inflation, really not a problem in Canada, nor the U.S. For that matter. There was fear of deflation. We believe that that's pretty much behind us at this point. That inflation will continue to sort of look within the target range of both the Canada as well as the U.S. In terms of stock market performance, second quarter of 2013, we did see quite a bit of red, starting with Canada, and a lot of that had to do with, first of all, just the makeup of our market that is very much geared towards the cyclical areas of the market. So we're talking about energy as well as materials and so on. So that definitely weighed on the Canadian market. Now, should China, sort of our forecast for China, should that happen, then we could see Canada, and if the U.S., the economic activity in the U.S. Revs up or continues to rev up, then we could see the second half of the year much more positive for Canada. Japan is the one that surprised us on the upside, both in the first quarter as well as the second quarter. Pretty much what, since the election of Prime Minister Abe Shinzo in December, and his aggressive reform mind, if you will, in trying to get the Japanese economy back on strong footing and sustainable footing, definitely investors have taken a shine to the Japanese market. If you look at year to date, I mean, it's up nearly 50% in local currency terms. Definitely the market of choice. However, we still believe that Japan has major structural problems, major demographic problems as well. So the gains that we're seeing in the first half may not repeat in the second half at this point. And in terms of emerging markets, right now you're looking at huge bargains, both in terms of regions of emerging markets such as Latin America. There are a number of countries such as Mexico, Colombia, Peru, Chile that are very, very interesting for investors. Brazil, being sort of the big 800-pound gorilla of Latin America, is definitely having its challenges. I think President Rousseff is facing quite a bit of unhappy voters at this point, and so definitely there are structural problems there that need to be addressed. In terms of S&P TSX sector performance, I mean, again, the first half of this year has been more defensive, more non-cyclical, and we could see that continuing as well for a little while the cyclical sectors have been the ones such as the energy as well as materials have been the one really to take it on the chin, and if anything are the ones because they're anywhere between 40 and 50%, the weight of them are anywhere between 40 and 50% of the index. Definitely that's weighed on sentiment for the Canadian market. And if you look at the different S&P TSX indices for that matter, you're seeing that REITs as well as any other type of income trust are the ones, especially with fears of higher interest rates, and we're seeing the yield curve go up. They're the ones that have been suffering the most at this point. Small cap stocks in Canada are at a bargain at this point, and again, a lot of that has to do with the makeup of the small cap market being very much heavily in cyclically in tuned. In terms of the bond market, and this is where we talk about the great rotation. Definitely the bond market since the beginning of the year has known a little bit has known some challenges, and so we're seeing here with fear that the quantitative easing is coming to an end. So we saw the response of investors or bond investors as soon as that was interpreted as the Fed sort of putting an end to quantitative easing as soon as September, and the market, where both the U.S. Treasuries as well as Canadian bond market went down. So on the quarter, the bond market, which is the graph on the left-hand side, and the left-hand side bar, you can see down about 2.4% on the quarter. It is really the long end of the curve that's really been hurt the most, and that is when you're seeing the yield curve progressively getting steeper. That's usually what happens. The long end of the curve is the one that is hurt the most initially, and then it sort of follows to the mid and the short end of the curve. However, not all bonds are created equal. You have different types of bonds, from government bonds to corporate bonds, and these corporate bonds, some of them can be investment grade or below investment grade. And what we're seeing here is that the safer, in terms of fixed income security you're in, the more you're suffering in terms of losses. The high yield segment, however, is the one that is still positive, although fairly flat on the quarter. However, still sort of presents some opportunities for investors. In terms of the yield curve itself, I mean, we're seeing the steepening of the yield curve, and that is the bar on or the curve, if you will, at the top, where we're seeing the difference between December at the end of last year and 6 months later. So we're seeing the yield curve steepening more and more, and we expect that yield curve to continue to steepen. Now, at one point, bond yields will be attractive again, or bonds will be attractive again. Don't forget that there is an inverse relationship, if you will, between rates or yields and prices. The yields go up, prices go down. So at one point, the yields will have gone up quite a bit. Prices will have come down quite a bit, where there will be some buying opportunities. So again, what you'll see is that reversed, but that could take some time before that actually happens. This is quite interesting. If anything, is and again, why we believe in this great rotation. If you look at bond yields versus the yield on stocks, or dividend yield, if you will, there aren't many time periods that where yields on dividends, or dividend yield of an index, much higher than bond yields, or the 10-year bond yield. This is the S&P 500, and only 3 times now since the 1940s that this has occurred. So back in 1940, back in 1980, and then 30 years later in 2010, where you're seeing that yield pick up in dividend. And that's one of the reasons why we're saying that this great rotation has some legs, and we believe that we're going to see more and more interest in equities. More interest you have in a certain asset class, the more it's going to be bid up. So again, we believe that that's going to happen to equities. The 10-year or the 33-year bull run, if anything, may have come to its end, and we may experience its first negative year if we look at the bond market as a whole. For the first time since 1999, a lot of investors are fed up of just getting 2% coupons, and or worth, if you will, in terms of yield. So they're looking at other opportunities, and these opportunities are presenting themselves in dividends. In terms of why equities are so attractive at this point, again, it talks about the fact that dividend yields out of equities much more favorable than bond yields. Again, at one point that's going to reverse itself, but for the time being, and we believe that that's going to continue for some time, it should still be good for the equity market. Dividends are becoming more and more attractive. Yet now 80% of the S&P 500 companies that are paying dividends. In the 2008 era, you had some companies that had cut dividends. Now they're coming back to the market as dividend payers. So definitely this is something that's quite encouraging. The fact that the yield is also turning around for the better, or the payout ratio is increasing, should also be positive for dividend investors. And you're seeing now that nearly 56% of the S&P 500 market now of those companies are trading more, or the dividend yield higher than the 10-year Treasury yield. And in terms of the great rotation, we believe that investors are looking more closely at the equity market, will continue to do so. You're looking here at equity as a percentage of U.S. household financial assets now, which is running just below 40%, which is higher than what we had seen in 2008. When people were divesting out of equities and going into fixed income. That should also continue for the next little while. In terms of the Canadian dollar, again, we still see, it's very strong correlation with commodity prices, especially oil prices. It's correlated to the tune of about 70%. So 70% of the time that oil prices go up or down, the Canadian dollar is going to follow suit. In terms of the Canadian dollar, it has lost some momentum against the U.S. dollar. We think, however, that's temporary more so than anything else. And if it does continue to trade below parity, it shouldn't really be more than 95 cents U.S. If anything, it should trade between 98 cents and $1.02 U.S. at this point. And in terms of Europe, it's still a concern of ours, definitely. I think that it's more of a generational issue, more so than anything else. So we'll be long dead and buried and turn to dust before all of this settles itself. However, there is some optimism out there. We're seeing that the European Central Bank's bond buying scheme that it implemented in 2012, although they haven't really used it, it's there as a strong backstop. There is definitely an easing of tension in many of those countries, although again, Cyprus was sort of a wake-up call for many of the troubled countries. Equity markets are performing well as well, and we're seeing one of the reasons is because a lot of these European multinationals, the bulk of their or a great percentage of their revenues is derived from outside of Europe as opposed to within Europe. And bond spreads are narrowing as well. So if you take the bond spread between Italian or Spanish bond yields and those of Germany, which is sort of the benchmark, you're seeing that because of the easing of tension, those yields have, or that spread has really narrowed over the past few months. There is definitely some pessimism and definitely some roadblocks out there. The type of bailout scheme that Cyprus implemented was scary at best. Spain and Italy still remain quite fragile. Spain, politically speaking, is an area that is of concern for us. Slovenia and Malta could be the next dominoes to fall. So those will be watched very closely. So definitely volatility in the European market still exists. In terms of economic performance, we're seeing that there's really nothing to write home about. And compared to North America, definitely there are more countries in Europe doing much more badly than here in Canada, as well as the U.S. One big concern is definitely the unemployment rate in Europe that's hovering around, in the Eurozone, it's hovering around 12%. But you're looking at youth unemployment being extremely high across many countries in the Eurozone, Spain, Portugal, as well as Greece. You're looking at 50% plus. So you have a lot of those young folks between 16 and 24 with a lot of time on their hands to throw rocks and Molotov cocktails to political or government authorities. So what should an investor do? Definitely remaining diversified is key here. So it's the best thing to do. We do have a very strong home bias in Canada. It's around 67%, or 2/3 of our portfolio is geared towards Canada. Canada is a very small market, so looking at diversification is should be core to everybody, and trying not to overreact to short-term events. These events will exist, will continue to exist. Just trying to understand what's happening, and also making sure that your portfolio does reflect your risk profile, I think is key here. Definitely some opportunities that can be exploited here. Stock markets, we still feel that are still valued attractively, even despite the recent rally. We think that, I mean, if you take, let's say, a hockey metaphor, we think we're more in the second period rather than the third period at this point, and pretty much at the beginning of the second period, where you're seeing markets or economic momentum just starting, as opposed to being really hot economy more so than anything else. The U.S. remains the largest and most transparent market, and should really, just because of its diversification aspect, should really be part of a well-diversified portfolio, again, depending on your risk profile. And Europe. Don't negate Europe. I mean, for those who have at this point, you may have missed out on some important opportunities. Again, many of the European multinationals, most European multinationals derive their revenue, the bulk of their revenue, from outside of Europe. Emerging markets right now are at a bargain. If anything, for the past year, we've seen emerging markets go down in value. A lot of that has been driven by China. We don't think China is going away whatsoever. If anything, they're presenting right now, China as well as many regions, emerging markets, are really presenting opportunities at this point. Now, I'll take this opportunity to field any questions that you may have regarding this presentation. Now, due to the high volume of participants in today's webinar, I may not have the opportunity to address all questions. If there is something you'd like to follow up on, though, please contact BMO Investor Line. They know where I live, so they'll ask me those questions. Again, just to ask a question, just to remind participants how to ask a question, just hover at the top of your screen. There's a toolbar there that will appear, and just click on the Q&A button. Quite an interesting question just came through in regards to commodity prices and oil prices and so on, in terms of where we do we think that oil prices will go. And this is talking about WTI, or the West Texas Intermediate, as opposed to Brent, although we're seeing the gap or the spread between those two kind of narrow, or maybe even becoming even at this point. Oil prices are trading just around $105, $106 at this point. We do not believe it'll go up to that 147 that we had seen a few years ago. We may be above the $100 level for a little while. The tensions definitely in the Middle East are something that we keep a good eye on, and definitely will have an impact on oil prices. So either Syria or Egypt and so on. However, on average, oil prices should remain below $100, but definitely not go up to the highs that we've seen a few years ago. A lot of questions are being asked in regards to Fed action on its quantitative easing. And a few weeks ago, when the Fed sort of pronounced itself on perhaps being ready to taper off or tapering quantitative easing as soon as September, that kind of spooked investors. I think that, and Bernanke has come back trying to explain himself and being quite quite direct with the market, saying, that doesn't mean that we're going to pull the trigger on this. We think that before the government does, or the Federal Reserve does anything in regards to stopping quantitative easing, we think that there has to be way more evidence of sustainability in the U.S. economy, especially on the housing market, manufacturing, as well as employment. We've got to see that employment of 200,000 plus a month on a consistent basis before we'll be convinced that the Fed will be ready to do something. Now, should the Fed decide to start tapering off, it should be seen as a positive sign. Because the economy is doing much better, so hence corporate profits should do much better, and equities should follow suit as well. We've sort of become hooked on this quantitative easing, and I think that we have to be sort of taken off, or that punch bowl has to be taken out at some point. A question just came through in regards to the TSX versus the Dow Jones, and in terms of 15,000 versus 12,000 or so, give or take. At one point a few years ago, and again, this was when the Canadian dollar was trading at around 63 cents US. The Canadian market was ahead of the Dow. Now, the question is, why are we trailing the Dow? Actually, the S&P TSX should be looked at as sort of a broader benchmark rather than the Dow. The Dow is not it's not really indicative of the U.S. economy. The S&P 500 is more indicative of the U.S. economy. However, going back to Dow versus TSX. And we made a big deal when the TSX went above the Dow. So I definitely this is an important point here. I think what's important is the makeup of the market itself. I mean, the Canadian market itself, the stock market, is very much geared towards, I mean, 3/4 of it is geared towards three sectors: financials, energy, and materials. And energy and materials, especially materials, which is close between 40 and 50% of the weight of the index, definitely have been the ones that have trailed the index, or really weighed down on the index. So I think that's why that we're trailing so much. It's really a matter of the composition rather than the health of the Canadian economy versus the U.S. economy. There was another question that was asked in regards to the U.S. economy, where we have a 2% forecast versus some other investment banks or investment firms who may have a lower forecast of between 1.6 and 1.9%. Now, these forecasts are revised, and every time that new information comes out, we have we sort of use all of that information to see if we need to do any type of revision. Our forecast actually has come down over the past few months, from about 2.3% down to about 2%, and the last numbers that we received may sort of invite us to gear that forecast down slightly as well. But for now, and this is as of July 5th, we had a forecast of 2% over the next year. What do we mean by saying China is not going anywhere? We think that China will remain sort of the growth engine of the world, as well as emerging markets for that matter. And we're looking at consumerism more so than anything else as being sort of the driving trend of these economies. China is between a rock and a hard place right now. China wants to change its economic model, I should say, from investments to consumerism, and it's not easy. It's not something that they can do on a dime at this point. This is a big boat to turn around. But I think that what China is doing at this point will eventually work. And even at a forecast right now of anywhere between 6.5% and 7% economic growth rate for 2013 going into 2014, we're still looking at anywhere between 5 and 6 times more than, or 3 to 5 times more than what we're seeing here in Canada, as well as the U.S. And being the second largest economy in the world, a 6.5% growth rate means a lot. So that's why I'm saying that China is really not going anywhere at this point. Emerging markets are extremely interesting, and as I said at the outset, one of the slides that we showed performance of different indices or different markets, we did see emerging markets sort of being at a tail end, if you will, in terms of negative performance. And definitely, there are bargains there. Now, there are what we call frontier markets as well, and frontier markets are sort of where emerging markets were 10 or 15 years ago. Now, today's emerging markets are really becoming more and more developed, if you will, and I wouldn't be surprised that over the next year or so that a couple of emerging markets will become developed markets and will be part of our world, if you will. In terms of some of the more interesting frontier markets found today are found in Africa, and definitely the continent is developing into sort of very viable investment opportunities, and this is something that we're seeing, and this is something that we're taking advantage of as well. Nigeria, Kenya are types of countries and economies that are quite interesting. Now, there are certain risks that come with frontier markets, liquidity being one of them. The other thing also that you have to be careful of is accounting standards and sort of financial reporting. And also, the third thing the third risk is really the social, economic, and political aspect of many of these countries. Some of these are relatively new in terms of democracy, and so definitely it's something that we have to be fully aware of before we make investments. But for anybody with that opportunity, it's something that should not be negated whatsoever. And perhaps one last question in terms of sectors in Canada that will do well and other sectors that won't do as well. I mean, we're very close to the Canadian market. We know this market just because we live here, and so we understand it, and quote unquote we trust it, if you will. However, we do have like I said, a very strong bias. In terms of sectors that should do well, you you can sort of clump it into different areas, if you will. You have your cyclical sector, so that would be your energy as well as your materials. Information technology would fall into that. You have your interest rate sensitive sectors, so that would be mostly your financials, your utilities to some extent, as well as within financials you'd have your REITs in there as well. And then you have your non-cyclical, and your non-cyclical would be a lot of times more defensive sectors, so your healthcare as well as consumer products, the consumer discretionary, and so on. So those are sort of the three buckets. Right now, what we've seen since the beginning of the year is really that interest rate as well as non-cyclical sectors that have done quite well compared to the cyclical ones, mostly materials. We think that in the second half of this year, that scenario should kind of repeat itself. We may see the materials sector, again, depending on what happens in China, and if we do see sort of a turnaround in terms of economic activity, we could see the materials sector fare much better. The energy sector, with oil prices sort of hovering above $100, should also fare much better as well. However, there's still a defensive nature to investors, and that's why that I don't think we're ready to see investors leave sort of the consumer-related sectors. And the dividend, and because of that search for yield, if you will, that you can't find or rarely find unless you want to take more risk in fixed income, that yield search in where you can find that in dividend will sort of attract investors or will entice investors to stay in sort of your bank stocks as well as your consumer-related dividend-paying type of stocks. So now we'll wrap up the Q&A sessions. Thank you to all participants for attending today's webinar. There'll be a follow-up survey that will pop up right after you close the webinar screen. We do encourage you to fill that up. So please leave your feedback on our live webinar. We'll also be posting the recording of today's webinar shortly on our learning sector. So again, thank you very much to everybody who's participated in today's call.